Hi guys, good evening and welcome to Moneycontrol presents Market Weekly. I'm Karunya Rao and as always we're back to have an engaging conversation with a keen market watcher, somebody who's been tracking the markets, understands all the trends that are playing out and more. Let me welcome on board Gautam Duggad of Motilal Oswal, who's here with us in the studios to talk about the markets. Thank you so much for taking time out and coming over here. Let's talk about the week gone by. It was a very macro-heavy, data-heavy week, and today, of course, we had the RBI policy meet outcome as well. A lot of people typically don't understand or track macros, right? So, if I'm a new investor, how would you perhaps make me understand what's happening with the economy right now, going by the indications that we have, the numbers that we have?
Sure. So, thanks for having me here, Karunya. See, there are two ways to look at it. One is in investing, micro always takes precedence most of the times. But then there are times when macro becomes super important, like the times that we are in right now. For last 8-9 months, you would have seen news flow dominated by inflation, Russia-Ukraine war, US Fed interest rate hikes, and then of course crude oil prices, which were on the boil till about a month and a half back. Why this is important right now is because macro decides the discounting rate for equities, which is the interest rates in the economy. And when inflation is high, your interest rates obviously follow, which is what we have seen. US Fed rate has been up by 75 basis points in the past two meetings. Today, RBI has increased by 50 basis points. Our own repo rate is up from 4 to 5.4% now in the last 4-5 months. So essentially what it means that the discount rate that you're going to use to calculate the equity valuations is going up. And therefore, to that extent, your headwind for valuations goes up. Secondly, macro does determine the corporate earnings, with an indirect impact, right? When geopolitical tensions arise, which is what happened post-February when Russia attacked Ukraine, crude oil prices went up, so many other commodity prices went up, supply chains got dislocated across the world, and it again reflected in the higher commodity prices in a variety of things. And that had an impact on corporate bottom lines, corporate margins. Though India has remained relatively far more resilient. In fact, if you look at today's closing, we are now up a marginal point something for CY22, which is a big achievement. Most of the global markets are down in double digits. The big developed markets are down double digits YTD 2020. India is flat now after the rally that we have seen in the last 45 days from the bottom of 15,200. So that essentially means two things in my view. One is the entire FI selling that you have seen in the last 8-9 months that got counterbalanced by a huge domestic buying. We have seen about $33 billion of selling post-October. July was an exception because July was the first month when we saw buying from FI after 9 consecutive months of selling. And second, the corporate earnings. We all know FY22 was a rock star year for corporate earnings, where earnings have grown by 40%. FY21 was up 20%. On top of that, FY22 was up 40%. And this quarter so far is tracking at about 14-15% earnings growth. So these two factors have actually supported India in an otherwise very volatile global macro environment. And of course, news flows in the short term will remain very volatile on multiple fronts, depending on how global central banks behave and where inflation settles.
But from a market standpoint, right now, do you think all the worries, everything has been digested, factored in, and perhaps discounted? Because whether it's global news flow or local inflation and supply chain related worries, looks like the market has finally, it's over all of this negative news flow, and we're finally looking up. Last not couple of sessions, but last 1 week, 10 days, we've been quite resilient.
So if you look at the index, it gives you a picture that everything is okay now, because all said and done, India is up for the year when all the big global markets and emerging markets are down in double digits.
Right.
But risk, Karunya, is always in the unknown. Once you know the risk, that ceases to be a risk for the markets. So crude oil prices no longer remains a risk. Fed interest rate increases no longer remains a risk. Look at the environment today. Today, RBI increased by 50 basis points, slightly higher than the estimate. Commentary was not dovish at all, right? They have not changed their inflation forecast, but market didn't fall. So once the risk is known, it gets digested. What you have to always worry about is something which is unknown and therefore unforecastable, right? So we didn't know in January that there will be a Russia-Ukraine standoff. We didn't know that crude oil will hit $140, right? So one has to always, accept the limitations of forecasting and what can be known. From the known things, obviously, right now things are looking okay, given that there is some stability on the currency front as well, because currency was very volatile and it was down 7-8% for the year. It's pulled back a little. Second, corporate earnings have not shown any dislocation so far, despite all the macro problems. And consumption is looking up. Monsoon has been fairly strong. And we've seen a roughly 20-30% fall from the peak in variety of commodity prices, from the peak in June or May to the prices which are prevailing now, whether it is crude or LME commodities or industrial commodities. So a lot of things which were being feared about a couple of months back, those fears have moderated now. And that is why market is also pulled back. But risk, as I said, is always something which comes from unknown factors. Yes.
All of that you just mentioned, along with, of course, which the RBI governor also said, there's been a pickup in investment. Capex is also looking good. But the question is, when will we see it all start reflecting in the earnings, in the company's performance? Because Q1 largely was expected to be weak, and it has more or less delivered on the expected lines, apart from some outliers, of course, and good commentary as well coming in. But when do we see things stabilize on an earnings front? Do you also, if you want to share your view on...
You mean earnings
Q1?
for the corporate aggregate or any particular sector?
For aggregate.
So aggregate earnings have been fine, right? I just mentioned that for FY21, you had seen a 20% earnings growth, which was the highest in a decade.
Yeah.
Right? We had come out of an earnings recession from FY10 to 20, when earnings had compounded at just 6.5%.
Right.
So 21 was the first year of a double-digit earnings growth. And it was followed by an even higher 40% earnings growth in FY22. So in 2 years, earnings are up 60%. And our forecast for this year is about 18% to 20% earnings growth again.
Okay.
So far, we are slightly tracking below expectations because of the big misses which have come in this quarter from Reliance and Tata Motors. But even then, the estimates have not got cut by a big margin. They've been cut by about 100 to 150 basis points. Right, so Nifty estimates for FY23 are still at 855, 860 rupees, and about 1,000 rupees for FY24, which essentially means that Nifty will do a profit of 7 trillion rupees in FY23, which is double of where we were in FY20 at 3.5 trillion. In fact, this is one of the very important reasons why Indian markets have been outperforming, because corporate earnings has been one of the strongest pillars for India's underlying market performance in the last 2 years, right? Which is why when 10 years earnings compounded at 6.5%, Nifty gave you 8.5% compounding returns. Last 2 years, earnings are up about 60-65%, and market is also roughly up 60-65% from 10,500 to 17,000 levels.
What about valuations now? I mean, yes, we have recovered quite a bit from those June lows. But overall, do you think this, if we look at the price to earnings, are we still looking at... are they still in favor of large caps perhaps, or are you also looking at these mid and small cap names as well, which look attractive in terms of the business models and in terms of the ratios?
So let's look at valuations in two buckets. One is absolute. On absolute bucket, Nifty is now trading at 20 times FY23, which is neither too expensive, neither is it cheap. Now it's in a fair value zone. Our long period average, 5-year, 10-year average, whichever one you want to look at, is somewhere about 18.5 times. So on FY23, we are at about 20.5 times right now on Nifty. And on FY24, if you take 1,000 rupees as an EPS for FY24, we are at about 17 times. So valuations are in a fair zone now. They were offering some degree of comfort a month and a half back at about 15,000 levels. Having said that, they are not exorbitantly expensive. But now the job of a capital allocator will become incrementally harder, because now it will be more bottoms up.
Yeah.
Now, when you look at relative valuations, the Nifty mid-cap index is still trading at a premium of about 15% to Nifty, right? So mid-caps are very expensive even now, whereas small caps have slipped into a discount. Small caps are trading at about 14.5, 15 times on an index basis. So that is at a 20% discount to Nifty. In fact, if you look at Nifty small cap, today's index level, and compare it with the December 17 index level, which is almost 5 years back, it is flattish. So no returns from Nifty small cap index for 5 years now, which essentially means that the valuations were very frothy to begin with when the earlier upcycle ended for the market, which was December 17 was the peak of the earlier cycle. From December 17, your Nifty is up about 65%, mid cap index is about up about 40%, and small cap is flattish. right? So small cap relatively is offering better value. Mid cap is still very expensive. So to answer your specific question, I find more value in large caps versus mid cap. This is on valuation, but even on corporate earnings also, large caps are exhibiting far more stability. Every segment, which is financials, consumer, IT, cement, durables, the large caps have gained market share and consequently the profit share also from the mid caps and small caps.
Where are you placing your bets right now? You said bottoms up approach, but if say you had to invest or start investing today, where do you think lies value as well as a sturdy, strong quality business model? Which sector, which theme are you following closely?
So we like financials the most. It is the single largest overweight for us right now at about 35% in our portfolio. Banking earnings have been one of the strongest. In fact, for this quarter, if you exclude the financials, the corporate earnings growth drops from 15% to 0% for the first quarter FY23. So entire earnings has been led by financials for the quarter so far, right? And financials earnings in Nifty itself has quadrupled from about 450 billion in FY18 to about 1.5 trillion in FY22. So almost 3.5 times jump in 4 years, whereas the market cap has not, kept track with that underlying earnings. So essentially it means that the relative price value equation has become more attractive for financials. So that is one sector which we like. Within that, of course, our preference is more towards ICICIs and SBIs compared to HDFCs and Kotaks, given the relative earnings growth versus valuation comparison. The second sector which we have liked for 3 years now is IT, which was a big overweight and remains a big overweight for us even now, despite the underperformance for the year. Because we find cash flow, free cash flow conversion and ROE matrices one of the strongest in IT in India. Together, the top 5 IT companies in India over the last 7 years have made a cumulative profit of 5 trillion rupees. And they've paid back 3.8 trillion to shareholders through dividends and buybacks. And valuations have now come off from the October-November 2021 peak. And the third sector, which is where we are finding interest again coming back after 2-3 years of time correction, is consumer. Consumer staples basically, because raw material prices have come down, whereas monsoon has been progressing quite well. So the rural slowdown that one has been talking about, I think over the next 2 to 3 months, and some of the corporates have already commented about it, that rural is picking up quite well. Whereas the stock prices have been flattish for last 3-4 years. So consumer staples offers good value in my view. And then of course, the evergreen theme of consumer discretionary, names like Titan, names like Page Industries, some of the new listings like Vedant Fashion or Metro. These are very long-term oriented compounding stories in my view. And then of course, you have to then choose from the other cyclical sectors within which we like cement today, some real estate names, some logistic names. We are not very positive on energy. We are not too positive on some of the infra names yet, excluding L&T. And metals, we have gone underweight.
Metals, in fact, most people we've been talking to are largely cautious. Some are even bearish on the space. One question before we let you go. Typically we have a daily show where we get a lot of live viewer engagement. The one question that keeps recurring is, should I, will the markets again get jittery? Should I sell and exit my positions right now? Because, 10 odd days, we've seen a good run up and a lot of people are now thinking again it will tank or again there will be some volatility. So especially new investors, how would you tell them to manage these periods of volatility without getting tempted to just sell and exit? So
new investors should ask themselves 2 questions. Could they predict the market downturn back in January 22 when the year began, when Nifty was at 17,000, that it will be 15,200 in May? And then when it came to 15,200 in May, could they predict that it will be 17,400 in July? The answer to these 2 questions will tell you that it is very difficult to second guess markets short-term movement. The only time-tested wisdom which is applied in the market over a period of time is that you stay put through the ups and downs of the market, commit only that capital to work which you don't need in short term. And the market will do rest of the things if you have chosen your stocks well. Taking a guess at what the markets will do in August, September, October is a very tough game, and only liars and fools can find tops and bottoms, as they say.
All right. Great thought, and I hope our viewers are taking note of that as well. Thank you so much, Mr. Duggad, once again for joining us and sharing your readings of the market and your insights. Thank you.